Hello and welcome to this week's episode of The View. My name's Steve Lambeth and I'm an investment analyst and portfolio manager at Clime. Paul Zwee and John are having a break this week. I thought we'd do something slightly different. I don't want to spend too much time consumed with running commentary on the day-to-day movements of markets, but there are a couple of things perhaps to bring you up to speed with, given there is plenty of news flow. But I think more appropriate might be just to share some broader observations and a few things going on, recent developments on various economic indicators, a bit of a look at the ASX specifically in terms of where it's now being valued and an update on earnings. And then I would like to just go through a couple of observations on a feature of our market regarding quality growth companies and where they're at. And then I'll share an individual stock story as well. So to kick off, share markets, as you know, after a bit of a meltdown, have made more or less a full recovery. The ASX has shown a lot of resilience, and that's to be expected given what has transpired. As far as the US market's concerned, that's roughly flat. Interestingly, offshore markets have fared better regarding Europe, and Japan's still a laggard. What you'll find interesting to look at that chart on the left is that for what has been a healthy recovery, with some markets in fact ahead of where they were at the start of this year, from a sentiment perspective, and this is quarantined to the US, on the right-hand side, sentiment has bounced off of an extremely oversold position and has moved back to about a neutral level. What about economic indicators? I'll just share two. On this first slide, let's have a quick chat about the status of tariffs. Because we have still an amount of tariffs coming, there is reason to be wary that risks to corporate earnings have not receded, notwithstanding what markets have done and notwithstanding how deals will get done. There needs to be an appreciation of the gap that sits between when tariffs start and when they come to impact. And this slide is my short attempt just to show you a bit of a disconnect at present, which is from Macquarie. Down the bottom left, you can see that those amount of goods moving their way across into the US have now started to be hit with custom duties, and that therefore will find its way at some point onto the consumer shelves, or instead it gets absorbed by the companies importing the product. So the tariffs have arrived, but they are yet showing up. A way to demonstrate that is firstly on the bottom right chart, you can see producer price inflation, a measure of what is coming the way of both importers and makers of goods, has not yet picked up. That may well be because those tariffs are being absorbed, or alternatively, we are still yet to see the full impact of tariffs. And one thing just to alert you to is, from a discretionary retailer's point of view, if you think about many goods coming across from China to the US and how long it would take for a conventional discretionary retailer to be thinking about attempts to pass on those increased costs. In the top right table, I've just shown a handful of stocks, two US stocks, Costco and Target, and two Australian stocks, JB Hi-Fi and Supercheap, and their level of days inventory turnover. That ranges between as low as 30 days for Costco, which is more FMCG, right out to, in the case of Supercheap Auto, selling slower moving stock as long as 150 days. So there is right now a bit of a disconnect between the tariffs. They're at 30%, as you know, after the de-escalation from 145%. So they are real and they are happening. We're about 72 odd days into or since the April 2 Liberation Day. So it's possible we are still yet to see some of these tariffs come to impact at a consumer retail price point level. And so that needs to be carefully monitored. The other issue, of course, in the last week has been the Middle East and oil. I'm not an oil expert. I'll just remind you, of course, This is a very volatile commodity. It is volatile from first principles, as shown on the right-hand chart, due to the highly inelastic state of both demand and supply. So for the risk of a supply shock, you would naturally observe a strongly rising price. Our portfolio, fortunately, our concentrated equity portfolio, our flagship fund, is neutrally balanced here. We don't have a strong view expressing an expectation of either up or down. That's deliberate, and that's part of risk management. Oil, as you know, in real terms, has declined over time. So to us, it's not a commodity to have a strong long position in. However, it is a commodity with volatility that can add volatility to performance. So we have a balanced perspective there. What we do instead is have an investment in companies that are second derivative or second order beneficiaries of volatility in oil. And the two I'll call out to you here, firstly, Macquarie. On the left side of the chart, you can see Macquarie's commodities and global markets division is a division that sells services that involve helping clients hedge volatility in commodities, including energy commodities. And as you can see in the chart, there were booming conditions for Macquarie in the years of 2022 and 2023. That related to the Ukraine and Russia situation, followed by some mean reversion. And so you would not rule out, with volatility now back in energy commodities, that business is well positioned to start recommencing helping out clients from a client hedging perspective. So that is an example of a way to play volatility from a second derivative perspective. And then on the right-hand chart is Ampol. Ampol's a small position in our portfolio. We do not have the position on because we think of what the oil price might do. What we would note is there is an amount of oil and the risk of shocks to oil having an impact on refiners. So on the right-hand chart is just a plot of Ampol's price performance against the VanEck US and global refiner margin stock. So that's your names like Marathon, Phillips, Reliance, worldwide. And so with the strong recovery there, Ampol is possibly going to be a second derivative beneficiary from a tightening refining margin backdrop, given the risk of disruption to oil supply. I'll change gears now and just cover quickly an observation about the status of the ASX. As noted before, the ASX this year is up about 5% calendar year to date. It's interesting, it is all price. It is not earnings. Earnings are shown on the right-hand chart. They remain in a sideways trend. It is all just rating, and there's a split there courtesy of Macquarie Research between the PE of the industrials and the PE of the banks. We are certainly in a very elevated state, and that would lead to a view that earnings increasingly are becoming important for sustained positive returns from our local market. Well, what does that look like? Well, thus far, with the information at hand, the forecast for fiscal June 2026 is a year of growth, a year of about mid-single digit growth. Banks not part of that, but instead growth coming from elsewhere, such as real estate, modest improvement from resources, which have had a bit of a challenging time, and then, of course, industrials doing much of the lifting. Naturally, the question begs, will this 5% growth forecast manifest, or instead will we have, as per what's happened over the last 3 fiscal years, negative revisions that drag a starting point of positive growth down into a place where we no longer have growth? So that remains an important watch point in the period ahead. And here's one more just to mention. It's a big stock. It's over 11% of the ASX 200, and it is in a place where many fundamental analysts are naturally asking, how did we get into this place? And a couple of excellent pieces of research dropped this week, just revisiting the status of CBA on 29 times. On the left-hand chart, thanks to Barrenjoey research, CBA is standing out versus both domestic and global peers. And on the right-hand chart, this was a good time series to reflect, if you like, on moments we've observed across the ASX when a certain big stock takes hold and it becomes a very meaningful and significant representation in the index. So there's examples like BHP. There's a picture there of News Corp, if you can recall back in the TMT bubble. And we have also now CBA that's pushing up north of 10%. So it is naturally an observation about the influence of liquidity and sentiment. And it is very hard to define if and when the CBA share price will reconnect with fundamentals. But we have been here before. I want to just talk quickly about growth stocks, and I just want to make mention of how an amount of fundamentals and valuation analysis sympathizes not just with the prospects for a company as per what cash flows will be generated in the numerator of a valuation, but also how they get discounted via the denominator of a discount rate comprising, of course, a risk-free rate plus a risk premium. It just interests me that if you look at the chart on the left, I've used the NASDAQ and the PE and then plotted its PE over the last 10 years with the US 10-year government bond yield. And you can see right in the middle of that chart was an unusual but understandable spike up when central banks flooded the system with liquidity. Interest rates were very depressed, and that just goes hand in hand with how value is impacted for equities, and particularly growth equities, because they are long in duration on cash flows. We find ourselves today with still fairly elevated multiples, yet the bond yield has retreated. The bond yield on the right-hand side has not moved back down. It has moved higher and stayed higher. And so multiples are defying what ordinarily is a case of a risk-free rate being elevated, having a depressive impact on value. And so that is curious. The table on the right extends that further to a list of our local names. These are in some cases tech, in some cases not necessarily tech, but high-quality growth companies. You can see across the columns I've picked off mid-2019 when the Aussie 10-year, was 3%. That mid sort of 2021 period, as I mentioned before, as a very euphoric period when we were at sort of maximum loose policy settings, very depressed interest rates. And then final column is where we are today. And the message across each of those columns for all of those stocks, by and large, is we had a certain value being placed. In this case, I've chosen sales. I chose sales because some companies are not yet fully at altitude on their earnings and mature margins, so it's easier just to work with a simple metric of sales. You can see how we had a measurement going on back in 2019 that averaged out to be, in the high single digits. In the depths of that COVID period and 2021, before the Fed blinked and started raising rates, the median EV to sales multiple rose to about 11 times. Where are we today? Notwithstanding bonds are now at 4.5% in Australia, we are at 11.7 times. So it is a most unusual situation to be presented with. And I would just finally say on the far right are two columns. Maybe the growth rate has changed for the better. That would certainly justify a changed status of what to value a business on. That doesn't really shine through. I mean, the growth rate shown in that first column is the last 3 years, and then the growth rate in the right-hand column shows the coming 3 years. And that doesn't average out really any differently. In fact, modestly lower than what's played out over the last 3 years. I'll just take that now into an a stock-specific example. I don't want to pick on this company in any way. It is to be respected for its excellent track record. It has TechnologyOne as enterprise software has delivered outstanding growth. It is on now a global stage, or at least a stage where it's pushing into the UK market. It has a lot of runway ahead. There is much to like. With that said, as per the title, we ask, is a great business a great investment? Here's a picture in the table of FY26 forecasts from Consensus. They're a September year end, so they're in currently the FY25 year. I'll just work with FY26. You can see down the bottom for the earnings that are being forecast at 50 cents a share and a share price of $42, that's a PE of 84 times. If we assumed Consensus is right and look out to 2030 in the middle column, I would note the company's aspiration by 2030 is to be doing about $1 billion in revenue and a 35% profit margin. So the consensus is ahead of that forecast, which is a healthy and full view of what will play out. It manifests in earnings of $1, and the share price at 42 odd dollars means the PE would fall to about 41 times if the share price stayed where it is today. And have a look at the chart on the right. You can see the multiple for a fairly long period of time up until recently was sitting at around about 40 times. So that tells me there is either something that's fundamentally changed, which is not easy to identify from a growth perspective, or perhaps there's some sort of change from a risk perspective. But the challenge as an investor to lay down a fresh dollar in this business at $42 means you need for more than the earnings to be delivered if that 40 times multiple is where everything settles down. An alternate might be, well, what if we said, what sort of multiple will TNE need to be on by 2030 if we were to get a 10% return from here? So you would roll up $42 over the coming 4 years at 10% per annum. There's no real dividend yield, so it's all about capital growth. That'd get you to about $62. And again, if consensus is right at $1 a share, well, that's about 60 times PE. So this is the challenge in wanting to front up at a moment like this, notwithstanding qualitatively, this company hasn't put a foot wrong. And that will lead to, well, we seek out value and a point of difference and looking for a market that is misunderstanding the long-term wealth creation prospects of a company. I just want to make quick reference to PEXA. PEXA is a digital property settlement platform based in Australia. They have been around since 2010. They listed here in mid-2021, so we're coming up to about the 4-year anniversary. Expectations at the time were very elevated, and over the journey of being listed with a strategy to continue to operate successfully in Australia, which has all happened. There's been no failures. It's been very profitable. It has not overstepped the line from a regulatory perspective. Why the company has come unstuck from a value creation perspective is evidenced on the right-hand side. This is enterprise value to EBITDA. That has declined, and that's disconnected from peers. REA is not so much a peer from, it is real estate, but the point being it's a platform. It is a marketplace of buyers and sellers coming together. In this case, there's a broader ecosystem for PEXA across conveyancing, across banks, and real estate agents and so on. But it is nonetheless a digital platform with exchange and infrastructure characteristics analogous to other platform stocks that deserves a fair rating. Well, it's been derated, and that's happened alongside progress in earnings. And the reason for that, I think, is because expectations have been just too high about the opportunity to prosper in digital adjacencies that have been bought in Australia, plus the big one being pursuing prosperity in the UK market, which is analogous to Australia of more than a decade ago, a paper-based market ripe for change in all things digital settlement. Why we like it is because notwithstanding there is not necessarily instant gratification happening on the UK opportunity, we have a new CEO in place, Russell Cohen. He will put his arms around this and try to make some progress. We are prepared to be patient for that opportunity playing out. It is a market substantially larger than Australia. And I should also just mention, for the derating that's happened from $3.5 billion market cap in mid-2021, we are now down to under $2.5 billion. There's no balance sheet problem. As I mentioned, they're very valuable here in terms of their earnings, doing a mid-50s EBITDA margin. We think you can explain the entire share price just in the Australian business, giving you optionality at a future state when they actually can make some progress on the UK story. So that is the sort of tech and platform stock we like, noting before that many of the other ones on offer are now on eye-watering multiples. This is my last slide and I'll let you go. This is with what happened and the Santos bid. We've had a couple of others this year. The one on the left there didn't get up. The one in the middle, Domain and CoStar, did get up. But I guess I'm just putting this up there as a closing because it would seem that M&A comes and goes. It's infrequent, but you do wonder in this environment with whether it's buy versus build, whether it's interest rates starting to retreat from elevated policy settings, which will make capital cheaper for deals, and also our low dollar, the A dollar, from an offshore acquirer's perspective, would make for an attractive entry point as well. It is something that we're thinking about, not necessarily nominating stocks that we should own with the expectation of M&A, but certainly something we weave into our thinking on how things will play out across the market. I'm going to finish there. Thanks for your time, and we'll talk to you soon.